We're now looking at the Euro-Yen daily chart, and I've marked on the divergences, both the reversal and continuation divergences, with the lines connecting the highs and the lows, and the arrows showing the direction of the trade. We're going to work through the entry and stop loss levels and stop loss movement using the double buyer bar, double seller bar method, which is a very good way of reducing risk, locking in profits, and allowing your trades to breathe. It's very similar to the 3-bar trailing stop. However, it's slightly different in the fact that you only move the stop loss as the trade moves in your favor. That means that if you have buyer bars moving up and you're a buyer, you will be moving the stop loss. If you have seller bars and you're selling, you should be moving the stop loss. Again, it's all to do with the highs and the lows of the bars and whether it's a buyer or a seller bar. So without further ado, let's have a look and identify the divergences, the entry and stop loss levels as well. If we start off here on the reversal divergence that's formed, we can clearly see that there is a lower low in price action and a higher low on the stochastic, which gives us the reversal divergence. I've marked on with the red arrow this buyer bar here. We can see that that's the bar that gives us the blue line on the stochastic, the percent K line, that flicks to the upside, giving us the buy signal. That means that taking that trade, we would place ourselves an entry level, which I'll show in blue, 2 or 3 pips above the high of that bar. And our stop loss would be the lowest low of the last 3 bars. And I'll depict that in red. Now, that's the trade entry itself, is the entry 2 or 3 pips above the high of the bar. The stop loss is the lowest low of the last 3 bars. And the method we use to trail the stop loss is the double buyer bar, double seller bar method, which means when we're buying, we have to wait for 2 buyer bars, and when we're selling, we have to wait for 2 seller bars. They do not have to be consecutive. So let's just work through this example now, step at a time. We can see from the entry point, of course, the trade gets triggered. We can also see, looking at these bars, we have a buyer bar and a buyer bar. Now our stop loss should go 0.1% of price underneath the lowest low of the last 2 buyer bars. And the reason it's buyer bars in this case is because we're buying. Now we can see there's a very slight difference between the lows of these bars down here. So while our stop loss originally was underneath this bar, now we have 2 buyer bars here, buyer bar 1, buyer bar 2. We're going to move our stop loss ever so slightly underneath this buyer bar. The lowest low of the last 2 buyer bars less 0.1% of price. And 0.1% of price in this case is about 9.5 pips. We can see the 9.5 at the beginning here at 9.5. Roughly speaking and realistically here, we'd use 10 pips underneath the low there for our stop loss. We can then see the next bar comes along and it's another buyer bar. So we can move our stop loss underneath this bar here now, less the 10 pips underneath the low, because it's the lowest low of the last 2 buyer bars. A seller bar now appears, and a buyer bar appears. So bearing in mind, we can see we have buyer bar, seller bar, buyer bar. Well, the most recent 2 buyer bars are obviously this bar here, and also this bar here. So our stop loss now moves underneath here, because this is the lowest low of the last 2 buyer bars. It means we've actually completely removed our risk and we've got our stop loss 10 pips underneath the low of this bar, and we've actually locked in a small amount of profit. Seller bar, and then we can see we actually get stopped out of this trade. So we would have been stopped at having made, well, 47 pips, would have made about 37 pips there. And we were risking 110, so we made about 0.35%. Very small winning trade, but a winning trade is better than a losing trade. So we achieved 0.35% win, which we'll mark there. As we progress through from there, we now see the next arrow, and that's because we have a continuation divergence. We have a higher low on the price action and a lower low on the stochastic. And if we're careful here, we can see the actual buy signal was generated on this bearish pin bar. However, this next bar did not go any higher than this bar here. As a result, this trade was not triggered, or this order was not triggered. But with this bullish pin bar, we can see the trade was triggered. So we would have placed an order here to begin with, which was then cancelled, and we then placed the next order here, which we can see was then triggered. If we mark those on the chart now, there's the entry, and we'll mark the stop loss. Bearing in mind the stop loss is underneath the lowest low of the last 3 bars here on the entry, and it's 10 pips underneath there because it's 0.1% of price is 10 pips. We've been triggered into the trade, and we now have 2 buyer bars that are most recent, so we can very quickly move our stop loss to reduce risk. We have a seller bar followed by a buyer bar, and we can again add, out of the most recent 2 buyer bars, this one here and this one here, we can see that the lowest low of it is this one here. We can move our stop loss 10 pips underneath the low of that bar, and it holds at that position, still holds that position up until this point here, when we now have another buyer bar. And out of these 2 buyer bars here, the lowest low is this one, which is pretty much the same level and would stay in the same place. Another obvious buyer bar, but again the lowest low of these 2 buyer bars means it's going to stay where it is. And another buyer bar occurs. We can actually now move the stop loss from here underneath here, and we can lock in the profit that's been made through there. And we have a seller bar, and a seller bar, and a seller bar, and a seller bar. Until actually it appears we then get stopped at this point here. So in this case, it didn't make a massive amount of profit. It still made 160 pips from risking about 100. So it made us a 1.6 to 1 reward to risk, which is a good return from the trade. And we're happy with a 1.6% return there. There was potential perhaps to make a little bit more profit, but not a huge amount there. And we now have another opportunity. We can see that we have a slightly higher low in price action and an obvious lower low with the stochastic. We can then see on this bar here, the most recent bar, which I'll show you with the arrow, this is the buy signal because the %K, the blue line of the stochastic, points to the upside, giving us the buy signal. So if we mark on the chart now our entry level, a few pips above the high there, and our stop loss level, 10 pips underneath the low there. We can see that the trade does get triggered. But as this is a seller bar, we can't actually do anything with it. So we leave our stop loss where it is. But now that we have 2 buyer bars, we can see we can move the stop loss slightly higher, reducing our risk. Another buyer bar comes along, and we can repeat the process, moving the stop loss underneath the lowest low of the last two buyer bars. And another buyer bar comes along, which enables us to move our stop loss once more. And another buyer bar, so we can repeat the process. We've stopped reducing risk now, actually starting to lock in profit at this point. Only a small one granted, but profit is profit. We're just still in the trade at this point in time. We can see where our stop loss is currently, just in the trade, but it then gets stopped out. So this particular example, we would have made about 40 pips from risking 115 for another small winner of 0.35%, but still a winning trade is a winning trade, far better than a losing trade. And we'll progress through now until we see the next signal, which is actually around here. We can see the higher high in the price action, we can see the lower high in the stochastic, and we can see when the stochastic actually flicked over and pointed down, it gave us a sell signal underneath this bar here. Now the next bar did not go down lower than the low, therefore the order was not triggered. And we can see actually the stochastic then points to the upside. Therefore, we actually cancel this order and do nothing else. And it's not until this next bar up here, which completes this train track formation, until the %K blue line actually points back down again and allows us to place our order underneath this seller bar. I'll mark that on there now, showing the blue as the entry and the red as the stop loss. And sure enough, we can see we've actually been triggered into this trade. The trade is still running. And we have a seller bar and a seller bar. Now, because we're selling through this point, we're going to put our stop loss to the highest high of the last two seller bars. Therefore, the stop loss moves to here, because this is seller bar 1, this is seller bar 2. The highest high of those two bars, plus the 10 pips, puts it to the position that I've just illustrated. Let's just check as to what this is here now. But we can see that even if this were to be a seller bar, the stop loss would still stay in the same place, because that would be the highest high of the last two sellers. We have a buyer bar, and this bar here, this small little doji bar, opened at 974 and closed at 957. It opened at 97, closed at 95. That's actually a seller bar there. We're still in this trade. Now we've had our next seller bar up here. And as the most recent two seller bars, 1 and 2, we can see that the stop loss now gets moved to this position here. So very small movements, we're reducing our risk with an aim to lock in profits if we get the opportunity to do so. Our stop loss is still in the same position. Still in the same position. And it's not until this point here that we now have the opportunity to move it. Seller bar 1, seller bar 2. We can move that stop loss behind there. The highest high of the last two seller bars. And we can see how much risk we've reduced. We've now got about 0.25% risk on the table. We haven't got the full 1% at risk anymore. Another seller bar and another seller bar completes the process. We can now move our stop loss again down to this level. We've completely reduced our and removed our risk, and we've now actually locked in a small amount of profit. opens at 03 and closes at 01, it's a seller bar, seller bar, seller bar. We can move our stop loss down to this level. Seller bar, seller bar. We can again move it down to the highest high of the last two seller bars. We can see that we're locking in additional profits as the trade continues in our favour. We're actually now in a position whereby we're looking to reverse the trade. We no longer want to be short. And the double seller bar routine through here has actually enabled us to stay in the trade and lock in the profits. We can also see this continuation divergence. The higher low on the price action and the lower low on the stochastic, when the percent K, the blue line, flicks to the upside on this inside bar here, that was actually the buy signal. But we can see this next seller bar comes along, and this bar does not go any higher than this one. Therefore, this order would have been cancelled. But now that we have the percent K blue line still pointing up, we place an order above this bullish pin bar, an order to buy 2 or 3 pips above the high of the bar. And that will go here. And bearing in mind, because we're actually looking to get long off of that bar, our stop loss, of course, would have come down to the same level, so that we'd have been stopped out the short and triggered into the long simultaneously. And the stop loss for this new trade is 10 pips underneath this bar. Because we're using 0.1% of price, we can see the price is 100, so 10 pips underneath this bar here. And we can see, of course, we then get triggered into this new trade and stopped out of this previous trade. Now on this trade here, this short trade, we're risking 145 pips, and we achieved around about 195 pips. So we achieved around about 1.3% return on that trade. We'll just make a note of that. A 1.3% return, again better than 1-to-1. Not amazing, but better than 1-to-1. We're now in this long example, and we can see the 2 buy bars through here, and because we have these 2 buy bars, we can now move our stop loss under the lowest low of the last 2 buy bars. A seller bar appears, therefore we do nothing, and we have another buy bar. We can now actually completely remove our risk and lock in profits. A very nice position to be in. And another buy bar appears, allowing us to move our stop loss once more to lock in additional profit. We can see an additional buy bar up there, which allows us a small move in our stop loss. And another buy bar, which again allows for a small move in our stop loss, consistently locking in profits along the way. We have another buy bar formation, so again the lowest low of these most recent 2 buy bars can move our stop loss once more underneath the lows of these bars, less than 10 pips. A seller bar appears, therefore we do nothing. Another seller bar appears, do nothing. And that's when we actually then get stopped out of the trade on this bar here, generating a profit of about 435 pips, which is a significant winning trade. 435 pips there, with a risk of merely 102, making us around about 4.3% on that one trade alone, which we'll of course keep a note of there, a 4.3% winning trade. Very nice winning trade when it comes along. We've now been stopped out of the position and we'll wait for the next entry signal, which is being created by divergence. And here we have it. We can now see the higher high on the price action and the lower high, the obvious lower high there on the stochastic. And we're actually waiting for the %K, the blue line, to point to the downside, which we can clearly see has happened on this seller bar, which gives us the entry signal. We'll go ahead here now and mark our entry and our stop loss. The entry, of course, being in the blue, and the stop loss being in red. And our stop loss here is 10 pips above the high of this bar, because this bar here is the high bar, the highest high of the last 3 bars. We very quickly get triggered into the trade, and actually seller bar allows us to move our stop loss very slightly in our favour. A buyer bar appears, we can do nothing, and another buyer bar appears, stop loss wise we can do nothing there. But the interesting point to note is we actually have now developed a continuation divergence buy signal. We have a higher low in the price action, a lower low in the stochastic, and the blue line, the %K, is pointed to the upside. Therefore we're looking to get long now. So this short trade that we're currently in, we need to move the stop loss to the entry level for the new long trade. We're actually reducing the risk there. We've got our stop loss and our entry level above this bar by about 2 or 3 pips. And our stop loss for the new trade will go underneath here, the lowest low of the last 3 bars. We can see this trade actually gets triggered in and actually stops out our previous trade, meaning that we lost 95 pips from a risk of 150. So we lost around about 0.2% there. We'll call it a minus 0.7%. Minus 0.7%. But we can see this minus 0.7% is less than a 1% loss. That's good because we've got a smaller loser than we were potentially capable of taking. We reduced our risk on that trade. And this buy signal now is being triggered in. We can see, of course, we've got buyer bar, buyer bar. We can immediately reduce our risk on this trade, which is good. And we can continue to do this on the next bar, the buyer bar, the lowest low of the last 2 buyer bars. We've moved our stop loss to almost around the break-even level. Next buyer bar comes along, the lowest low of the last 2 buyer bars. We can move the stop loss. We've removed our risk completely and locked in some profit. We actually had a seller bar there, followed by a buyer bar. So we can move our stop loss once more underneath this bar here, because after the most recent 2 buyer bars, this has got the lowest low, less. Now rather than using 10 pips, we're now moving towards using 11 pips underneath this bar as our stop loss. The reason for that, we can see 108 to 109. Of course, that's 10.8, 10.9. We're not going to give a 10.8 pip stop loss underneath the low and the high of the bar. Therefore, we'll just call it an 11 pip stop loss underneath there. And another buyer bar. So we'll move our stop loss underneath here, less the 11 pips. And we're locking in profits along the way now as the trade moves in our favour. And another buyer bar formation. We're allowed a small movement to lock in additional profits. And a seller bar, buyer bar. Our stop loss is going to stay in this same position. And the next buyer bar, which we can see pushes up, allows us to move our stop loss once more, locking in even more profits. Again, another buyer bar and another stop loss movement. We then have a seller bar up here and a buyer bar up here. We can actually move our stop loss underneath the lowest low of the last two buyer bars, less the 11 pips. Still moving in our favour. We have another seller bar here and another buyer bar. We can move our stop loss once more underneath this bar. Because of the most recent two buyer bars, this one has the lowest low, less the 11 pips. This doji bar here is actually a seller bar. It opened at 115.17, closed at the 13. It's a seller bar, and our stop loss remains at this level. And another seller bar, and another buyer bar. We're still in this trade. Our stop loss is yet to be hit. Let's just measure that and double check. We see actually through here our stop loss could well have been hit, so we'll assume that it has been. We look at the low of this bar, it was 78. So from 67, our stop loss would be at 113.67 there, underneath here, and we'll just check what the low of this bar here is. 113.53. We would indeed have been stopped out there. That therefore gave us a profit of around about 610 pips, which is a monster of a winning trade. 610 pip gain with 150 pip stop loss. Therefore, generating us a percentage gain of around about 4% on that particular trade. A very, very nice winning trade through there. That brings us actually up to the current point in time, whereby we actually have ourselves a lower low on the price action, a lower low on the stochastic, a higher low on the price action, and we can see the buy signal here, once the blue line flicked up, it's currently running 190 pips in profit and going strong. Now, looking at this through here, we can see that you've had some smaller wins of 0.35%, and the double buyer bar, double seller bar routine through there has enabled us to completely eradicate the risk and lock in a small amount of profit on that trade. Here, it allowed us to generate a good profit on the trade, although not perhaps as much as it could have done if we'd have been slightly more aggressive with our stop loss management. A 0.35% win. Again, considering that this trade did not go particularly far, it still generated a profit, reduced the risk, and locked us in with a small profit through there. A 1.3% gain to the downside through there, ran from the absolute high bar to the absolute low bar, as good as it could have been. And the 4.3% win through here ran significantly in our favour, perhaps not quite as far as it could have done, but certainly, while locking in our profit and reducing our risk, a very good way of allowing the trade to breathe. The only small loser through there was a 0.7% loss, so not even a full 1% loss. Yes, that would have taken out some of the small winners through there, the 0.35s, but you can see the size of the winning trade at 4.3%, 4%, 1.6% easily makes this a very profitable approach to trailing your stop loss. As per the 3-bar trailing stop, this is a very similar system which allows us to reduce risk and lock in profits while still allowing our trades to breathe and move in our favour. Spend some time now, like you already have done, with a 3-bar trailing stop and familiarise yourself with this double buyer bar, double seller bar trailing stop loss method. familiarise yourself with it, and decide upon which method you prefer between the 3-bar trailing stop and double buy, double seller. They are very similar methods, but you can't chop and change between them. You must choose one and stick with it. Therefore, to begin with, familiarise yourself with them both, understand them both, and look at the upsides and downsides of them both and decide which one you intend to use.